Welcome, everybody. I hope that you're enjoying the conference virtually. My name is Oliver Wright, and I am the America's head of mining and metals at the global law firm White & Case. I'm delighted to be joined by an exceptional panel of leaders from the investment community. And today we are going to be discussing how do investors assess whether their investment into a mining company is truly ESG compliant. Joining me today are Kaylee Barker, who is a director in the natural resources investment team at BlackRock, Ian Maxwell, who is an operating partner with Pacific Road and who has an impressive history as both an operator and an investor, Tal Lomnitzer, who is a portfolio manager at Janus, where he is responsible for managing the global natural resources fund strategies, Phil Hopwood, principal at KWR Capital and who is a veteran advisor to the sector, and finally, John Houchen, the Secretary General of the Council on Ethics for the Swedish National Pension Funds. And John has been deeply focused on the mining sector recently, having been a co-convener of the ICMM's Global Tailings Review. Against this backdrop, firstly, and before we get into questions for the panelists, I want to set the context for today's discussion. Obviously, 2020 and the start of this year have been heavily influenced by the COVID-19 pandemic. However, after the initial shockwave, the industry has proven its resilience, with majors able to keep the world's largest mines operating and global supply chains continuing to hold up despite the logistical challenges of the pandemic. In fact, many segments of the industry are thriving, with copper and iron ore trading at its highest levels since the 2013 boom, and gold outperforming during the course of the last year. Now, ESG matters are not new to the mining sector. The sector, by its very nature, is always going to, and really should always face intense scrutiny in this area. And I know from speaking with all of the panelists prior to today that no one here would disagree with that. I also expect that everybody tuning in today agrees that ESG matters are important for the mining sector. But the questions we are hearing, especially from junior companies, is what should they be focusing on? And how should they be presenting themselves to investors in this regard? We also hear that with the recent focus in this area, there are potentially too many standards to adhere to, and that the industry lacks a systematic collective set of standards for demonstrating compliance. Firms face an alphabet soup of disclosure and reporting frameworks and a patchwork of national standards. So for example, there's the IFC and the UN Sustainability Guidelines. There are sector-specific standards such as the Extractive Industry Transparency Initiative, IRMA's Standard for Responsible Mining, the ICMM's Global Tailings Standard, SASB, and the list goes on and on. And while companies can bemoan the burden of compliance, I think that it's evident that those who embrace this issue and outperform the sector in terms of ESG compliance are ultimately benefiting. So with that, John, perhaps I can start with you. You live and breathe this topic and see it impacting all sectors of the economy. Can you elaborate for us on what you see as the opportunities and the challenges that are facing the mining sector specifically?
Well, and thank you for having me here, Oliver, and thanks everyone for joining. Look, I mean, during the pandemic and the last couple of years, the transition is really picking up very rapidly. I think the consciousness about climate change and where this planet is heading has really sort of landed, and people are moving and societies are moving on the transition. The transition is going to need a lot of metals and minerals to happen. We all know that. So it's a huge opportunity out there for the mining industry. Having said that, we also know it's a very challenging environment for the mining industry, especially to establish new mines. And we know what good looks like and we know what bad looks like. We've been working with these issues for more than 15, 20 years now. And we know what to expect when it comes to establishing new mines, and especially in terms of working with communities and corruption and what have you, setting up a just system for sharing the revenues from mines, etc., etc. I think the good investors and the people on this call, they know what good looks like and they know what bad looks like. And to your point on these standards, and I think we'll be elaborating a lot about that. I think it's maybe sort of a dead end to be screaming too much about standards. I think junior companies can easily pick out, there's a lot of free stuff out there. Steal with pride. You can frog leap a lot of, experiences that many of the major mining companies have done over the years. You don't have to redo the mistakes they've done. That's one thing for sure. And especially when you establish the mines, be very, very careful, because communities are well heard, and communities needs to be treated really well in order to get that good start for mine. Yeah, and a good kickoff. I think that's really, really important now. So mining is going to be center core and focus for the transition decade that's happening now, and we need this decade. It needs to happen, otherwise people will lose faith in the transition. And I think we'll see some drastic measures being taken by different governments and what have you, and that's not going to help anyone. So we need to move with haste, but we need to be really smart, and we need to cooperate. I think the mining industry needs to be cooperating. Maybe the junior companies need a bit of help of some of the leading major companies to share knowledge, share experiences. I also think we need to call out collectively where we have mines that are not being started in the right way, or where there are issues, corruption, what have you. We don't really have time for that, because it's sort of killing the whole industry. It's dragging the whole industry down to a common denominator, and I don't think the industry can lose that kind of speed. So, but knowing that, I mean, just looking around now, the group of people on this call and the people I meet within the financial industry that is looking at ESG, it's become huge. So if you want to be part of pension funds like the Swedish AP funds and other large pension funds in the world, you need to ride that wave in a good wave. So, but it's very interesting, and I'm quite positive actually about the future of mining, to be honest.
Thanks, John. Actually, one point you mentioned there, which I thought was very interesting. I know you and I have often spoken in the past about the fact that the market will ultimately require and reward good performance. But you did mention that we should be starting to call out poor performance. Where do you think that pressure is going to come from? Which is the body or the group that is likely to apply that pressure or start calling out poor performers?
Well, I've actually told a number of large mining companies over the years to call out when they get unfairly treated, or if they get pushed out of the system because they call out on corruption, what have you. I think we need to have a very transparent discussion about these very difficult issues. I think we need a fair and responsible mining sector. I think we have all the pieces in the puzzle there, but it also, actually, to be straightforward, it really, we need countries that, governments that are prepared to start mines. They need to play that game. I mean, we're an active member of the EITI, as you mentioned, and I think it's a good tool, but the EITI needs to pick up its game on mining as well. So look, it's a collective endeavor, and I think there's some brilliant mining companies out there that will make really good investments for pension funds, but we like the markets, we like competition, and even within ESG, this is all a competitive environment. Let the best company win.
Excellent. Phil, I want to turn to you next, but before I do, I want to address an elephant that's in the virtual room. When we spoke earlier, we spoke about the importance of diversity, and I recognize that on that ESG metric, our panel is not outperforming. But with that to one side, I wanted to ask you, why is diversity important? And why are other ESG performance metrics so important to companies? And how does KWR Capital approach this topic?
So there's a couple of things there, Oliver. One is, we kind of approach it from the perspective of, I mean, as much as it's wonderful to have a whole bunch of people looking like myself, running companies and the like, that doesn't really give you much diversity of thinking. So we approach really for the diversity of thinking. You really do need that, which, by the way, is a thing that is very much championed by BHP. They've been an absolute lead with that. The largest mining company in the world. They have 50% of their group executive who are actually all women, and they're in the really senior roles as well. So have you seen their share price recently? I mean, the runs are on the board there, really, aren't they? So it's around diversity of thinking, and of course you can have ethnicity diversity on top of that as well. Absolutely, but you really want to have that, right? So what are we doing about that? Well, if you look at our organization, my main partner within KWR Capital is Emily King, who's a geologist with a background in Afghanistan. She did the geological survey there, and she's kind of like absolute kicking goal, especially with them put there for her prospector portal as well. So it's important. And when I was with Deloitte, I was the global mining leader with Deloitte for 10 years. One of the things that kicked them along in terms of changing their partnership structure to actually have more women partners within their organization was when they realized just how much more money they can generate by having a stronger gender diversity in their organization. And I think people have actually done that analysis down at the side level in mines, haven't they? You've actually seen that the better drivers of trucks are women rather than the men.
Right, so performance speaks for itself. And
absolutely, yeah.
How does KWR Capital approach this issue and challenges on other ESG topics? Is this a sort of static screen, or do you see it as partly your role to sort of work to improve this issue?
Well, it's so interesting. So we deal really much within the junior sector. We're looking at around sub $100 million, maybe 100 to 200-300 with the near-term developers. We're very focused on trying to bring new investors into the market. So another elephant in the room within mining, if you like, in general, is the need for new investment. I mean, John talks about this all the time when you're on your podcast and the like. How do we bring in new investors? By the way, Eric Sprott is not a new investor in mining, right? And the market capitalization of this critical sector is minuscule compared with some of the techs, right? And the reason why we can't get the new investors in is because they're actually pretty scared of this sector. We have arcane rules. We have strange ways of going around. We talk in funny little terms and things like that, right? And nobody can understand why the commodities rise and fall. And by the way, look at the share price of some of our largest gold producers right now, with a gold price that is $300-400 an ounce more than it was last year. And their share prices are less than they were a year ago. And investors look at that and they say, well, how does that work, right? And then, of course, they look at the people running the juniors, they look at the people running the explorers, the developers, and they look at them and think, right, are these people good people to invest in? Because we all do what I would call quantitative analysis to arrive at a qualitative judgment. Is this company a good company to invest in? That's what we do, right? And one of the things that you look at there is the management teams, and you look at the boards of directors. And with all due respect, if they're all from the same background, and it wasn't that long ago where some of our largest mining companies in the world had a whole board of directors that were all investment bankers from Oxbridge. Let's be honest, let's call that one out. It just doesn't work. It just scares people off. They kind of go, oh, well, I'm out of here. Bitcoin looks pretty good to me, and they're going to lose their money there. This is not good. So we have to reach it and change it, right? And so that's in terms of people want. I mean, they want people to have not just good policies on the ESG side of things, but what are you actually doing about it? So that's what we say as well. When we go through our criteria in terms of is this a good investment or not, one of the basic questions you actually ask yourself is that what are you actually doing? So what are you actually doing to engage with First Nations in Canada, rather than do you have a policy or have you met them in the airport?
No, that's a really good point. And by asking those very obvious questions, I suspect you quickly form a view.
Well, that's right. I mean, have you seen how many women CEOs we actually have especially the junior mining sector? I mean, I think we've no more than, and call me out if people disagree, no more than 5%, and I think I've been pretty generous with that. It wasn't that long ago. I did one of our one-to-one meetings recently. I think it was the Mines of Money Connect one, and I think out of maybe 60 companies that we met, maybe 2 women CEOs. I mean, how does that work?
Right. Kaylee, I'm going to turn to you, and you really represent the big end of town at BlackRock. Presumably, BlackRock, therefore, sort of has amazing resources available, both to assist you in screening and also to assist you in working with the companies you invest in. Can you tell us about your approach?
Sure, thanks, Oliver. Yeah, I mean, yes, that's probably correct. You know, we have the advantage of being a large global corporation, so we have not only lucky to have fantastic access to all the, you know, not just mining companies, but companies across the globe, you know, in all sectors. So we have that cross collaboration between all our different teams. Plus, we have our own individual stewardship teams and sustainability teams, and they engage with companies directly on ESG issues, corporate issues, sustainability issues, etc. So you know, we are spoilt in that regard. You know, what we tend to do is we have our own in-house screening system. We use a range of different data sources from all over, and we compile our own screening tools. We use those for the investment teams as well as for the stewardship teams to assess their criteria as well. And it sort of all comes together in a pot. We use those to, you know, make our investment decisions, and those screens are, you know, as much as anything, on a guideline. And I think some of the earlier comments will echo all of that. You know, it's a journey. We're all learning as we go. You know, the mining industry has been around a long time, but and mining companies have been doing these, you know, good ESG practices for years, but it never has the heat been so hot in the sector. And we're all learning from both sides, the investment community and the mining community, what is actually needed, what is the correct things to report on, how they should be reported, how they should be used for investment purposes, etc., etc. And I think you know, even a great company like BlackRock is still feeling its way through this. And the only thing we can all do is sort of push together. I think, as John said, you know, a collective collaboration is exactly how it's got to work. You know, the ESG experts, the investment community, and the mining companies all just doing their bit. And we've got to get this messaging right. You know, it's been a big focal point of BlackRock right from the top. You know, Larry Pink has put his letter out. He puts it out once a year, and this year most of it was about sustainability and ESG, and that's how, and it's throughout the whole organization. So that's how important it is to us. And the reason is it's not just greenwashing. You know, it's an important business for many reasons, not just because it's the right ethical thing to do, but it's because, you know, it has all kinds of implications, not just to the environment or good practice, but also to investment interest. You know, if we want investment in mining because we need it, because we need commodities to build all these things, then we need investment into the sector, and we get investment by getting interest, and we get interest by being a sustainable industry. And we know that on our team, the majority of flows that we've had in our funds over the course of the last year has been in our thematic funds, not in our. We've been fortunate enough to experience good interest in our mining and gold funds, but nowhere near to the level of extent we've had in our thematic funds. So if we can, as an collective industry, you know, come across as a good ESG leader, because we aren't at the moment, then we can enjoy that interest, that investment, and come across as the right kind of responsible sector that we know we are.
That's an interesting point that you make, that there's a lot more investor interest in the thematic funds. How do you think can the traditional miners sort of capitalize on that investor interest, which, you know, obviously the mining sector is not really just one sector, it's sort of several different sectors under a single umbrella. But how can the more traditional miners capitalize on that investor interest?
Yeah, I mean, it's a good question. You know, we're in the penalty box, so to speak, as a sector, and we probably will always be to some degree, I believe. And if you look where all the sectors, if you plotted all the sectors in terms of, you know, GHG emissions versus trend of improvement, mining is probably one of the worst, next to sort of airlines. but it's not all a dead loss. You know, many mining companies are trying to do better. The key is all about messaging, really. And in an ideal world, the industry will do what it did with, say, the all-in sustaining cost or safety metrics. It's been done before, you know, a standardized reporting metric, something simple that can be placed in front of the whole wide investor community to say, this is what we do, this is what numerically what the impact is, these are the metrics, and this is how we compare to each other and to all other sectors. And I think the sooner we can all try and get to that final, you know, piece of the puzzle, I think the easier it will be. And we know that's important because we see companies that follow the sustainability theme, they do generate a premium. We've seen it, and we've seen it in all kinds of sustainability funds. We know that if you're a good company, if you can demonstrate those sort of themes and you can just demonstrate them responsibility, it'll be reflected in your share price. So the impetus is on all of us to get it right.
Yeah, no, I think that's a really interesting point. And, you know, you're talking about the need for a sort of industry-wide approach to improving the messaging. John, I'm going to come back to you on that topic a little later, but I want to ask Ian and Tal some questions first, because I know that, John, you're doing quite a lot of work, if you like, on that sort of industry-wide approach. But Ian, you've done a lot of work in your role at Pacific Road, designing a framework for assessing investment opportunities and being a responsible owner. And you also benefit from having been an operator at the coalface, if you'll excuse my pun. Can you tell us a bit about your work and how you work together with operators?
Yeah, sure. It's a great question, Oliver. Maybe I can just set the framework for what we're specifically doing in the sector first and echo some of the comments of the other presenters. If you look at energy transition and you look at where it has the biggest impact, it's going to be in some of the markets, which are actually some of our smallest markets right now and are dominated by pretty small companies that have relatively low capacity and capability compared to the majors to do things. So when you look at industries like graphite or nickel, you know, they're not big industries compared to some of the big diversified organizations. I think Phil was and Kaylee were talking about the investor appetite in the sector. You know, it is a scary sector. We've got technical risks that people don't understand. We've got commodity risks that people don't necessarily understand. You compound that with a history of pretty poor capital management up until recent times. And then you throw ESG risks on top of that, and it really becomes a almost uninvestable piece. And so I think one of the reasons why ESG is becoming so important is because, you know, in the absence of strong ESG management, for many people, this sector is uninvestable. Something you want to invest in, but at the end of the day, you can't. Now, Pacific Road, we're a concentrated investor, so we typically invest in positions between anything between 5 and 100%, but oftentimes our positions are 20, 30% of a company. And so we are in a slightly different position from others in our ability to really get into the companies and have a look at what they're doing. So many of our companies, mid-tier companies, junior companies might have 1 or 2 assets. So again, they also have concentrated portfolios. So our starting point with our companies is to really help them through the quagmire of what's important to them. You know, you can't do everything. So really understanding what is the most material risks for those businesses and those companies, and really focusing on the material. And I think if you look at where the industry has had failings in recent times, even at the bigger company levels, you know, the industry wasn't focused on tailings. Look what happened. You know, John, who's on the call here, led the piece with the Church of England about the global tailings standard. You know, there really wasn't the focus on tailings in the industry before that. If we look at corruption, you know, prior to tailings, we had a number of other major failures. Lo and behold, this year, industry not really focused on indigenous rights, and you can see what's happened. I mean, time and time again, we do this. So our starting point with the companies is to sit down with a materiality framework and say, look, these are the key risks time and time again you're going to be faced with in the sector. Let's have a think about your company. Let's have a think about your assets. Let's have a think about where you sit. And let's think about the materiality of those things. and then let's steer the company to who are the most appropriate global bodies, organizations, standards, etc., where you can see what the right thing to do is. So for example, in tailings, it's easy, go to the global tailings standard. That's, if you implement that, you're going to be doing the right thing. Nowhere else you need to go and look. You know, when we talk about things like corruption, if you're in a high-risk country, I think John mentioned earlier, ETI, you know, be a member of ETI and introduce the ETI principles and concepts into what you're doing. You know, if you're in a low-risk country, then corruption may not be an issue, but maybe indigenous rights are, and you want to think about the UN Declaration on the Rights of Indigenous Peoples or whatever it might be. And so it's really about working with the companies to help them through the vast offering of things that are out there. And actually, when you cut it back, it isn't so vast. There are a relatively small number of things that you've got to do right, and there are a very relatively small number of bodies that represent standards or best practices in those areas. There are an awful lot of service providers that are jumping in and promising to help and deliver and do this and this framework, this question set, this matrix, which I think confuses the issue. So a lot of what we're about, Oliver, is cutting through all of that with our companies, helping with the most material and pointing them in the right direction.
Thanks, Ian. No, I mean, that sounds really useful sort of guidance that you're giving to the companies and value that you're bringing to the companies that you invest in. I'll turn to Tal quickly now. Tal, can you tell us about how Janus Henderson is embedding this sort of analysis into your investment decisions?
Sure, with the greatest of pleasure. And before I do so, let me thank you for inviting me to join this panel. So at Janus, you know, this sort of stuff is what we would have characterized historically as non-financial risk factors, crucial to a company's license to operate. And so we've been looking at them for a very, very long time. We just didn't know it was called ESG. As that sort of narrative has become increasingly important and increasingly widespread, we've learned how to communicate that better, and how it's formalized into our process. And as it's sort of moved from being a risk control factor for us to actually being an alpha generator, as Kaylee alluded to, you know, you're now starting to see outperformance from companies that are doing this well. And reducing exogenous risk factors can ultimately lead to better risk-adjusted returns. And that's the holy grail for us as investors. I think there's, you know, from our perspective, it starts at the beginning of the process and it goes all the way through to the end. At the beginning, with negative screening, we look to exclude high carbon content energy sources. So we exclude coal, for example. One of our funds, we're now moving to exclude oil. By the way, we run resources funds, so energy, mining, and agriculture all together. So with that negative screening, we sort of exclude parts of the universe. We also exclude underperformers on ESG grounds. And then we also filter for positive thematics, companies that are exposed to sustainability and driving sustainability, helping clean the environment up, and so on. So it's a combination of that that then feeds into the middle of the process. And much like Katie described, we use a combination of internal analysis that's combined with external third parties like Sustainalytics, for example, but we use a number of parties for the sort of in-depth analysis. We've got our own template that's got about 40 factors that we track. Some of them are binary. Do you have a policy? Do you not? Some of them are quantitative. About half of them are actually quantitative. We measure those over time and look for improvement. And I'd really like to send a message out there that you don't have to be perfect. This is a journey, as Katie mentioned, and I can see the other participants nodding. This is about getting better. So a company that is committed to improvement and can demonstrate that improvement is an investable company for us, even if it's not a top decile performer on all these various ESG criteria. And then there's the end of the process. Once all of this feeds through and combined with valuation criteria, we end up with a portfolio that we measure various characteristics of. We look at the carbon footprint, we look at the controversy risk, we look at the overall ESG risk, and we go a bit further down and engage with companies continually if we find that they're in breach of any of these particular factors. We vote actively, we engage collaboratively. We've been active participants in the initiative that John was a co-founder of. We've been involved in the engagement piece of that, and would you know, I've got as much rope as I need internally to get engaged with these sort of activities. And so it then circles back to the beginning of the process. I'd really like to echo something that came up from a few of the comments, which is about perception. And I think there is a big gap between perception and reality in this sector. It's not exactly a poster child for responsible investment. And that's because every time somebody picks up the newspaper and reads about a mining company, it's because something bad has happened. The enormous contribution that this sector makes to sustainable development, economic development, local development, reducing inequality, the list goes on and on and on, is missed by this. And it's partly, I think, because there isn't an ability to brand the different products. You know, some copper cathode, 99.99% is copper cathode, regardless of where it comes from. But I think that that's going to change, and I think companies need to appreciate how that's going to change. We will soon see the emergence of copper contracts that account for the inputs that go into them, whether that be the carbon footprint of that particular piece of copper, whether it be the water usage. It might even go down to more social-like characteristics. We're starting to see contracts like this being launched and traded. Now, there's an open question. Will these trade at a premium? Will other contracts trade at a discount? But we've seen this happen in the oil industry, where you've got a benchmark crude and everything else references off that. And I would not be surprised to see that emerging in the mining space, which means that companies need to be building this in right at the beginning. How can they track all of this stuff so that comes to the end of the day, the Tesla customer who ticks the box for green copper or normal copper alongside, you know, do I want leather or patent leather or whatever it is, will be assured of the provenance of that. This is coming, and it's not a long way away. And I think companies need to be aware of that.
Yeah, Tal, that's a really interesting point. I mean, I think it combines, or picking up on 2 points you mentioned there, which is one, in your initial screening, that companies don't need to be perfect, but they need to sort of have a willingness to do the right thing, which really gets to the heart of what is their culture. And I guess that's really important to have that culture embedded before they're even a producer, before they're even anywhere near a decision or a negotiation on their copper contract. They need to make sure that culture and those processes are well and truly embedded.
Yeah, I'd agree with that. And that's why, you know, this is not just about spreadsheets and screens and so on. This is, for us, it's about getting out to site. It's about putting on a hard hat, steel toe cap boots, getting out there, kicking the tires, not necessarily because we want to get a better understanding of the ore body, which is of course important, but because we want to understand the culture of the company. And you can only get that by talking to the people on the ground, really understanding how they go about their business, and understanding how a lot of these very important factors are built in. You know, it's all very well operating by the letter of the law, as we found in the last year with, you know, social issues that have arisen. There's nothing legally wrong that happened there. But what happened is a sort of perhaps a little bit of a cultural issue, where it was applying the letter of the law, but not the spirit of the law. And then that sort of leads to the consequences that we're now seeing, which have been quite significant.
Right. I want to come back to a point that's sort of come up a few times, which is the need for a sort of industry-wide approach to solving some of these problems and to solving the perception issues. John, you know, I think the tailings review is a sort of step in that direction. Can you tell us sort of where you see the next steps and what more you think can be done?
So together with UNEP, PRI, Adam Matthews, myself, and the investor group is setting up an independent institute now to oversee the implementation of the global tailings review. So we're actually starting the hire process as we speak. I can't join the interviews because the interviews are starting now. So I might actually, my choice is to be with you guys instead. I hope that's okay.
We definitely appreciate it.
No, but I think it's going to be good. Let's be honest, that I think everyone agrees here that there's a huge business case for responsible mining. And we've set up a really good group of investors within the mining and tailings review. You have a number of them represented here. I think there's big interest into this. And I think if I was a mining company, I'd be very keen to participate in these discussions. You will be given a lot of free advice to what Ian has raised. There's a lot of free pickings out there. It doesn't need to be that difficult. And I think we're setting sort of a mining agenda for 2030, for this decade, to secure that mining becomes a responsible partner within the transition decade, and there you can attract capital as well. I think don't only see the downside, see the opportunities within this process as well. I think the good mining companies have already been hiring good people, smart people who understand sustainability. Junior companies can free ride on that knowledge. Many of the big mining companies are sharing freely. ICMM are sharing freely. But to the point, there's a lot of noise out there. I think collectively we can kill a bit of that noise, be clearer on what we expect, our expectations. And we can also, like we've done now with the tailings review, we can give standardized tools on a global basis that the investment community want mining companies to use, so we can see what good looks like and what bad looks like in a collective manner. It's not going to be perfect. It's never perfect, but there's room for efficiency here. But the institute is going to start with the independent review of the tailings implementation of the tailings standard, and I think that's a challenging and really important topic as well to start off with. But it's a great group of investors, and I don't think we're going to let them go. I think we need to work on this collectively because we need responsible mining. End of.
Right. And another topic that's come up a number of times so far is, there's a really positive story here, which is that for the companies that outperform, the companies that get this right, they generally outperform on financial metrics as well. Phil, maybe I can ask you, and now that you're back with us, is this something that you think the junior mining companies that you speak to get? Do they all get it, or is it slowly filtering through? What's your sense of the sort of uptake of this?
Well, it's a different world in the junior sector compared with the larger producers. I mean, one of the interesting things about this sector, of course, is that there's a very long tail in terms of you have, 5 or 6, 7 or 8, very large producers, diversified, and then it becomes a very, very long tail. And to say that it's cowboy country with some of those junior miners, I mean, I think I'm being rather kind. I'm describing it. So some of those disciplines and some of those things that you would expect to see, the larger sector. I mean, there's a reason why so many of those, the larger investors will not invest in the junior sector in gold. They just won't, because it's just too hard, too complex, and people have been too burnt by it as well. By the way, a lot of retail investors into this sector as well. If you see that, the day traders are all over that. If that is one thing that I've learned in the last year, is there's a lot of day traders out there working in the junior sector, coming and going just on a very short-term basis. I think it's so positive though when you hear, for example, the mining associations, and I'll give a call out, by the way, to the Towards Sustainable Mining initiative that was led actually by the Mining Association here in Canada. So when those industry standards are being pushed, and also you get the larger producers actually helping, and they have been very much so helping the junior sector in terms of the governance. But the reality is a lot of the people who are actually in the junior sector have actually been from the larger mining companies as well. I actually think there is a case for greater regulation as well. I know I'm in Canada, the home of bureaucracy sometimes, and we do like a bit of regulation, but there are so few companies that have actually been prosecuted for some of the things that they have been doing in the past. I mean, that's the reality of this sector. So, the regulatory frameworks that people have to adhere to in the junior sector, they really aren't there. I mean, some of us might have read Warren Aaron's 50 Things to Look Out for Investing in the Junior Gold Mining Sector, which is slightly tongue-in-cheek, but actually pretty valid as well. I mean, people have seen, the pump and dump scams that have been done in the sector and the like. So I think anything that can be done, bringing in more professionalism, better governance, better processes, it will bring in the holy grail, which is the investors. That will bring back the investors into this sector, who are still, I would suggest, pretty scared to come along and be part of this.
Yeah, that's really interesting. I mean, Tal and Kaylee, I'm going to ask you both, and either of you feel free to jump in. Do you see investors changing their sentiment towards traditional mining?
Not really at the moment. No, I mean, general investors. Now, when we look across other teams, we haven't really. They tend to move to our sector because they have to. Fear of missing out, which is investors' normal reason to look at us. But we are getting in, like I said, that they are sort of squeezing through the back door through the thematic side of it, and that's what's perking their interest. You know, there's sort of long-term themes, electric vehicles, electrification, etc. And I think if they, you know, if we can get this sort of messaging right, that's what's going to attract to them. I mean, you know, when they look for reasons not to own us, you've got to destroy those reasons. You've got to make them, you've got to not only make it attractive, you've got to make sure that there's all the boxes that they're crossing against are no longer valid. So there's less and less reasons for them to say no. And you know, a couple of things that will come very fast over the next year will be, you know, net zero targets, you know, proper quantitative numbers that are with direct targets for companies to meet them, and executive compensation linked to ESG. We've barely even touched that yet. You know, safety is very much embedded, but I think of all the companies I've met this year, I could count them on less than one hand that have mentioned pay that's linked to ESG. So that's another thing that sure as hell will be coming.
If I could just add to that, I'd certainly agree. I don't think that we've seen that wave of investors really coming back to the sector. I think it's, as Katie pointed out, it's more sort of a risk reduction than coming in with the genuine attraction to the merits of the sector and the valuation. But that is starting to change as the sector moves higher and that pressure increases. I think, you know, one of the things I personally think will help dramatically is if we reach a point where instead of reporting these things because investors want them and the companies feel that they should be reporting them, moving to a place of integrated reporting where these various factors are actually required as part of the financial statements, and it's sort of moving the information from the front half of the annual report to the back half of the annual report, where any investor can pick it up and look at it, know where it is in one place, and have a number of factors that they know are audited, agreed, and measurable and common across all companies. It's not going to be a perfect answer, but it's very much an important starting point for getting this data, which is, we've moved from having a lack of data to almost having too much data, and it's all in too many places, and it's hard to get hold of, and all the rest of that. And really, you know, at least from our perspective, we are encouraging companies to think about adopting now the SASB standards. I very much hope SASB will be absorbed into the FASB, the Financial Accounting Standards Board, and in that way, this will become formalized and required. And I think that will be a real step forward. When we meet juniors who encouragingly are increasingly reaching out to us, asking us to speak to the board, talk about ESG, how we think about it, and how they might start to build it in. This is the message that we're giving. It's start building in this reporting now. If I say to the CEO of a company drilling for copper in Ecuador, what's your carbon footprint? They should know the answer to that. I know that they don't have tailings. I know that they don't have enormous emissions, but at least knowing what they generate from the drill rigs, what they generate from all their flights around the world, it's tiny, but it's an important starting point. And it just shows an understanding that that needs to be captured, even if it's not entirely meaningful for a company at a very early stage of development.
Yeah, no, that's really interesting. And where do you think, I mean, ultimately, I guess the goal is that this is sort of mandatory reporting across all sectors and that there's a very systematic approach. But where do you think the first push is going to come from in order to in order to start seeing some more consistency? Is it going to come from industry bodies, or is it going to come from regulators? Where do you think the push is?
I personally think it'll come from regulators who are just trying to capture more and more of this stuff, the sort of ESG materiality factors. We all know that different factors have different materiality to different sectors. We're starting to see this get ironed out. There's a number of different groups trying to push their own versions of this forward. We're encouragingly seeing them now starting to talk a little bit more to each other and recognize each other. You've got to choose one at the end of the day. It almost doesn't matter which one you choose, but just I would say to a company, choose something and start reporting it and work from there.
Yeah, no, that's really good advice. Ian, I mean, if you had that one bit of advice for operators, what would it be?
Look, I think the focus on disclosure is right. I mean, in order to improve, you've got to know where you are now, and in order to be transparent and open with society, you need to tell people where you're at. I don't think companies should be afraid of putting that stake out there. It was raised earlier by a couple of the people on the call that no one's expecting any company to be perfect. But if you want to improve, you've got to have that stake. And I think high quality disclosure for me is where that starts. And unlike the bigger companies that the BlackRocks and the Janus Hendersons might be investing in, I'm sure Phil would concur. If you look at companies sub 2 billion market cap and even companies down below 500 million, it is astounding how many of those companies don't have a standalone ESG report. Yeah, there might be a comment or a line or two in the annual report, and that's about it. And they're simply not good enough today. It's simply not good enough. There are good frameworks out there. SASB was mentioned. GRI is another one. You can put these things together. You can start reporting fairly quickly. And I think what we've seen in the industry, Oliver, is when the industry leadership has put its mind and attention to things, it's generally done a pretty good job. If you look at the attention that was put to safety across this industry over 20 years, and you look at the safety statistics today, this industry puts other industries to shame in terms of its performance. It's done a good job. If you look at carbon reporting, starting to do a good job. It's relatively easy to report against carbon given the inputs and outputs, it's starting to get there. But you look at some of the other more challenging issues the industry faces, much more difficult. And I think getting some material disclosure around that, whether it's around tailings, whether it's around indigenous performance, whether it's around air and water quality. I mean, these things are really, really important to get out there. They're a little bit more difficult, but we've got an industry that's shown it can do it.
Yeah, no, that's a really valid point. John, you want to respond?
Yeah, but I think this is good, and I also think, I mean, look, there's a lot of young people out there that are really, really burning for sustainability in general. I call them fire souls. I'm a fire soul myself. Some people call them internal NGOs. But my recommendation to junior companies is to start recruiting these kind of people. So don't be afraid. You need your fire souls internally. They will help you. You need to learn from them, and you need to attain their energy. There's a lot of cowboys out there. I know that within junior companies, but they need their fire souls. Then you're going to need that fire soul to increase value of your operation. And that fire soul will help you to do all the stuff that we're talking about here now. So don't be afraid to recruit young people with strong ideas about sustainability. It's the only way forward. And we also need much more young people coming into the industry. Look at ourselves. I mean, this is an all-white, middle-aged group of people sitting here talking about this. We need young women, diversity in every kind of way joining the mining industry. It's not going to survive otherwise. So recruit your fire soul. That's my recommendation.
Thanks, John. I mean, I think, and we're coming to the end of our time. I mean, to wrap up, it really, I mean, I think we've all heard that there's a lot of room for improvement, but it's not necessarily that difficult, and that the benefits are really there, that there's real upside for the companies that get this right. So from my perspective, I want to thank everyone for the time that you've taken today and for sharing your insights. And I think it's been an incredibly valuable discussion.